Hi guys, a very good evening to all of y'all. Hopefully my screen is visible as well as y'all are able to hear me out. Okay. So today we will be looking at a question which is known as Handfood, which is tested in your December 2020. Right. This is about 4 years back. Okay. It's quite in the past. So this question is ideally will be tested, right, for 25 marks. Okay. So this question would be, this would come as your third, either your third or the fourth. Okay. The reason I would say it could come as your fourth question is because they are testing something related to current issues. Okay. This is what are called current issues. Can you see this very first requirement? This is known as current issues, right? Current issues means there are some current, I mean, there are some issues that we face in our day-to-day activities when we are doing financial, right? How do we account cryptocurrency? You all know cryptocurrency was developed within the last, say, about 5 to 8 years back, right? So still no one has found out how do we account it, or neither there is a proper accounting standard for accounting for cryptocurrencies. Okay. Uh, and there's another one. Nowadays, have you all seen that majority of the companies are focusing towards sustainability, right? Towards eco-friendly products, okay, towards recycling. Okay, so now because of them focusing towards that, do you all know that there is no standard that exists for sustainable? So that's why there is something called sustainability reporting, right? When you all are reporting that, you all should make sure that this has to align with IFRS and IAS, right? So there's these particular standards or articles that have been given in your ACCA hub, right? So what I want y'all to do is I would want y'all to go and have a readout. Okay, just go and try to read and understand. Okay, try to go and read these technical articles and try to understand. Well, this is important for you all to pass. Okay, so far in your until skills level, right? You all would have not gone and read any technical articles. Me personally, I did not do. But if you need to score for SBR, right? If you all need to score more than 60 and above, more than 50 and above, right? Have a read on your technical articles. Okay. So that is it in terms of your requirement number A. Okay. So what I would say is small and medium enterprises, right? Small and medium enterprises, even though this was tested 4 years back, right? Nowadays, examiner has shifted his focus, right? He is mainly focused on few of the standards, right? The articles that examiners currently focusing on would be, okay, how do you account for cryptocurrency? Is it an intangible asset? Does it fall under your financial instruments, or different sort of that? Okay. How do you report materiality? How do you report integrated reporting? There is something called integrated reporting, right? And also there's something which is more important, which plays a prominent role in now these days finances, sustainable finance reporting, right? These are some important technical articles. Let us slowly build on. Okay, there are so many, right? There are so many, but for now, these four have a read on whenever you all are able to. Okay, by at least November, right? For the people who are planning on sitting for December sessions, make sure that by November, second week or third week, that you all are able to read and complete what is technical articles. Okay, don't need to go and read out the entire paragraph, grabbing those important points, right? Make sure you just have a short notes here and there. 5 points, 6 points would be more than enough. The rest is you all need to build up. Okay. The rest is you all need to build up. So there's something called debt versus equity, right? Because why there are some directors, right? They manipulate accounts. How do they manipulate? They purposely show your debt as equity, right? You all can go and read out. You all can go and read these articles out, right? This will help you all. Okay. So if you all need to pass, you all need to make sure that you all have technical articles in your hand. Okay. Yeah, that's it for your requirement number A, right? Make sure that you read integrated reporting, right? Make sure you read this. This has been tested for the past three, I guess, three exams. In the current session, it has been tested. Examiners keeping on testing integrated reporting, sustainable reporting, what is the call? Uh, digital assets, right? So make sure I'll go and read this. Okay, this is important. This part is important. But for now, small and medium enterprises are least tested, right? They are least tested. I would not say that they are going to come or not, right? But so far, they are least tested. Okay. So if that is so, let me move on to our B requirement, which is focusing on which will be focusing on IAS 19, which is a employment benefits. Right. This is one of your major standards. This is one of your major standards. I have been seeing, right? I have been seeing examiner has a particular liking towards this standard, right? IAS 19. Make sure I'll go and have a read it. Or make sure I'll practice much as possible of questions that is related to this. Okay. So this has been tested for 6 marks. What does he want us to do for 6 marks? Well, he want us to discuss as well as give some calculations, right? On what does he want us to do? He wants to show. Sorry, guys, give me a minute. Let me plug in my charge. Let me plug in my charge. Right. So there was a sorry. So there was a 6 marks question, right? The 6 marks, what we need to do is we need to bring up some discussions and we need to prove it with calculations, right? We need to prove it with calculations on what? What is the requirement? Here comes the requirement. Okay. Examiner, what he wants me to do is he wants me to show the accounting treatment for how do you treat current service cost, right? Current service cost. There's something called current service cost. When we read, I will explain to you. Okay, on 31st December 2002. This is all that the examiner wants you all to do. Okay, this is all that the examiner wants you all to do. Just show him the accounting treatment for current service cost under IAS 19. Right, this is all he wants you all to do. For 6 marks, simply 6 marks, guys. Simply 6 marks. I guess 2 marks might be allocated for calculations. 4 marks might be allocated for this one, as far as I could remember. Okay, if that is it, if that is it, shall we move on to our question? Okay, so that's it. We need to know, we need to do something related to current service cost. Current service cost. Okay, fine. Okay. So for that, obviously, I might be needing to read from here. I might be needing to read from here. Okay. This for now, you all can simply ignore this. Sorry. This particular part, for now, you all can simply ignore this because it's a least tested standard, as I mentioned before. But for the people who want to know, you all can go and read it on your technical articles, right? Okay. So, where is the background as usual? Here it is. The company's financial year end is 31st December. Fine, they have not given us a year, no problem. On 1st January 2002, okay, Handfood has given a benefit, right? Of what? Say this. What do they say? Handfood is coming up with a benefit scheme saying that if you all stay in my company for 5 years, right, I will give you all some cash or I'll give you all some bonus, right? He is introducing this particular scheme to keep it in simple. On when? On very first January 2002. If you all stay for more than or at least 5 years, you all are entitled for this benefit, right? Or bonus or something he's planning on giving. Okay. A lump sum. Obviously, you all know, right? Bonuses are declared, right? They are not, they won't be given over the year, right? They'll give at once. Okay. So that's what they mention it as lump sum. Lump sum means at once they'll give you a big amount or a large chunk of your salary, right? Which is payable on 1st January 2007. So obviously I told you, right? 5 years. January 2002 means 2, 3, 4, 5. 31st December 2006 would give you all 5 years. Okay. Which is equal to 1% of their salary, right? So the bonus or the lump sum would be 1% of your total salary on 31st December 2006. Okay. Under one condition. Under one condition. What would be the condition, guys? Here it is. Here it is. Under one condition. If you all remain employed until that date, until 31st December 2006, for whoever the people are remaining in our companies, or for the whoever people who are employing in our company until 31st December 2006, they are entitled to get that bonus, right? So simple. If you all are not there in the company on 31st December 2006, if you all don't have a chair, you all simply don't get that particular bonus. That's what they say, right? That's what they say. If you all need to get that bonus, a lump sum of bonus, right? You all need to make sure that you all have 5 years. On 31st December 2006, you all need to remain in your chairs, right? That's it. That's it what the examiner says. Okay. Let me further read on. The discount rate is 5% per year. Okay. He has given us the discount rate. Discount rate, obviously, it can be used to find present value, right? It is used for present value, interest rates, multiple sources, right? Let us again go on. Current salary of 1st January is 1.1 million. Fine. Okay. 1.51, 1.1 million. And they have the following assumptions, right? Until the current financial year, it will remain for 1.1 million, right? But from the very next year, 1st January 2003, your salary will increase by 3% each year. Okay, 3% each year. So from 1st January 2003 to 31st December 2006, your salary will be repeating or increasing by 3% each year. Okay, make sure you all have that in your heads. Okay, and also they are coming up with a very last assumption, right? With their very last assumption. What is it? There is a 75% of probability, right? That all employees will still be employed, okay, on 31st December 2006. So what they mean, there is only 75% who will remain. The remaining 25% have left the company. That is it. That is it that you all need to know. That is all it that you all need to know. Okay. So let me create a story. What the employer says, what the director says. For the people who stays 5 years, right? I'll give you a lump sum of bonus, right? But under one condition, you all need to be in your seats, right? You all need to have your chair until 31st December 2006. Okay. So on 31st December 2006, only 75% of the employees were there, 25% has left. Right. Here comes the benefit. 3% each year. He is planning on increasing his salary. Okay. So before I read this, let me read this also. Recognizes actuarial gains, right? And losses in other comprehensive income, right? This is where he is going in, or that particular actuary is going and recording the gains or losses from remeasurement, right? This is all that I would read. This is all that I would read. The remaining four lines I would read once that is relevant. Okay. So now again, before I answer my question, I'll again go and read. He wants me to show how do I account the current service cost. Simple as that, right? Simple as that for the employment benefits. For the employment benefits. Okay. The employment benefits. So I have told here. Okay. I've told here integrated reporting I want you all to read. I have put in asterisk, right? It is quite important. Make sure you all read it, right? For the people who have done SBR, you all might be knowing what is integrated reporting. You all would have had a slight touch, right? Anyways, make sure that you all go and read. Okay. Here comes the answers that I have prepared for you all. Here comes the answer that I have prepared for you all. Okay. So, so what you all need to understand is, for the people who have gone through the recordings of IAS 19, for the people who have gone through IAS 19 recordings, okay, for the people who have gone through IAS 19, there are three type of benefits that normally a company gives, right? Some might be short term, okay, some might be long term, some might be post employment, right? These are the benefits that can be given by an organization for its employees. Okay, these are the benefits that will be given by organizational directors for their employees. Some might be short-term benefits, some are long-term benefits, some after you leave the organization, there are some benefits. Okay, so let me give you all some examples. This would be pension. Okay, this would be short-term bonus, right? This would be long-term bonus, right? Okay. Okay. Now we need to confirm whether this is a short-term bonus or long-term bonus, or either is it a post-employment benefit, right? Is it a bonus or is it a post-employment benefit? Okay. Can you all see? Can you all see? Can you all see that this particular bonus, guys, is given for 5 years? For 5 years. So if it's 5 years or more than that, right? If it's more than 12 months, anything less than 12 months. Right? So what I want to tell you all is, if the benefit is more than 12 months, you all can go and classify it under long-term benefits. Okay, unless it does not fall under your pension scheme, right? Unless it does not go and fall under your pension scheme. Okay, this is what you all need to know. If it's a long term benefit, make sure that it is more than 12 months. Make sure that the benefit is more than 12 months. Okay, and also make sure that it does not fall under pension scheme, right? Make sure that it does not fall under pension scheme. Okay, here it is. That is what I have told you. Here it is. Since they have been settled for 12 months, sorry, for more than 12 months would be ideal, right? They are settling for more than 12 months. Here, since it's more than 12 months, right? You all can consider it to be a long-term benefit. You all can consider it to be a long-term benefit. So there are some people who ask, why doesn't it go and fall under post-employment benefits? Well, see here, see here. Normally, post-employment means what? You all have left the company. You all have left the company, right? You all are retiring. Say you all are retiring. Retiring is a way that you all leave the company, right? Retiring is a way that you all leave the company. In this particular question, you all remain at the company. Can you all see here? 75% of the employees remain, right? So these are given for employees in the firm, right? These are given for employees who retired, right? That's the difference, guys. That's the difference. That's the difference how you all need to categorize it between your long-term benefit or post-employment benefits. Okay, that's how you all need to differentiate between long-term benefits or post-employment benefits. Okay, so coming to relating the paragraph, this is more than 5 years, right? Obviously it's more than 12 months. Okay, we are considering it to be long-term benefit. Why? Because why? 75% of the employees still remain. Okay, let me put that also. 75% still remain. Remain slash exist. Right? They exist in the company. Okay. If they obviously they had left the company, we would have given them a pension scheme. Okay, you all know how pension works. Okay, you all know how the EPF, ETF works in your different countries. Okay, now, now comes, now you all need to speak. Now you all need to speak. How do you all do the accounting? How do you all do the accounting? Okay, how do you all do the accounting? Well, the accounting would be same as defined benefit pension scheme, right? The accounting is same, guys. The accounting is same as your pension scheme, right? It is very same as your pension scheme. Here, I'm marking that for you all. Let me mark that as well. Okay, let me mark that as well. Right? Same accounting treatment, right? You all need to have the same accounting treatment, but there's a slight difference. What's the difference? The only difference is any remeasurement gain or loss, right? Any remeasurement gain or loss will be given to P&L rather than OCI, right? So if you all do the DBP or if you all do the defined benefit plan or defined benefit pension scheme, right? What you all do is in defined benefit scheme, right? Defined benefit scheme, you all go and do any remeasurement gain or loss under other comprehensive income. Okay. If you all go and do defined benefit scheme, any remeasurement gain or loss, right? That will be transferred to other comprehensive income. Point number one. But if it's a long-term benefit, if it's a long-term benefit, the accounting treatment is same, right? The accounting treatment is same as the defined benefit plan, but only one difference is any remeasurement gain or loss needs to be transferred to P&L. Do not go and touch OCI. Do not go and touch OCI. Why? Because this is the long-term benefits procedure. This is the long-term benefits procedure. Okay. Other than that, apart from that, the entire this one is similar to defined benefit plan. Okay, everything is same. Everything is same. Only the remeasurement gain or loss. Right. Obviously, you know how does the remeasurement gain or loss happens. We will come up with our closing balances. Right. We will do a closing balance at the year end. The actuary or the investment firm, they will give us their very own closing balances. Any difference will be known as remeasurement gain or loss, right? If it's a DBP, that remeasurement gain or loss is ideally transferred to OCI, other comprehensive income. But since it's a long-term benefit in this particular question, this would be transferred to your profit or loss. Okay, this would be transferred to your profit or loss. Okay. Apart from that, both DBP and your long-term benefit has the same format, has the same accounting method. Only you all vary in your remeasurement gain or loss. Fine. That is it. That is it. That is it. Okay. And here it is. Here it is. Now I need to explain how do I calculate. It's not simply about calculation, right? This calculation would only get you all about 1 or 2 marks maximum, right? You all need to explain how did you all derive or how did you all come up with that calculations. Here is the explanation. Here is the explanation. Okay. Before I start off explaining the calculation, okay, I want people to make sure that you all attempt this particular question after you all study IAS 19, right? After you all study IAS 19, I want you all to attempt. Why? Number one, IAS 19 is the favorite topic of examiner. I will 100% guarantee you this time also you all can get an IAS 19 question. Sorry, let me keep it 99% because sometimes you all can blame it upon me, right? 99% examiner can test IAS 19. And also, if you all need to get an overall understanding, right, it is worth it that you all go and have a read at that particular standard. I would say this standard would take about, say, if you all dedicate within 1 hour to 2 hours, 3 hours maximum, right, you all can read, you all can understand. Okay. For the people who are watching my recordings on your Google Classroom, right, I have explained it. I have explained it in a simple manner. For the people who are doing self studies, right, and other people, other students who are not part of my batch, right, what you all could do is You could go and read Study Hub or either Kaplan study text for a maximum about 3 hours, and then start focusing on your IAS 19 related questions. Okay. So here it is. How do we do? What do we need to do? Can you all see here? This benefit is being paid for 5 years, right? This benefit is for 5 years. Can you all see? Here, see? Here, see? We are required to pay this benefit in another 5 years' time. Obviously, right? I have announced it. Can you all see? He has introduced. He has introduced. Obviously, we have given a public statement. When you all give a public statement, right? When you all give a public statement, obviously it creates an obligation, right? It creates an obligation. You all need to pay it in 5 years. So obviously, when you all know, when you all create a obligation, you all need to do, or you all need to record a liability, right? You all need to record a liability. You all need to record something called as the liability. Okay. You all need to record something as the liability. Why is this benefit? Simply you all need to ask yourselves: is this benefit being given today, or is it being given after 5 years? It's being given after 5 years, so I need to record a liability. I need to record a liability. So obviously, when you all are recording a liability at today, you all need to give it at present value. So at today, what is it terms? You all need to record it at present value, right? You all need to take it to today's terms, right? You all need to show it at today's terms. Why? We are going to, there is an outflow, which is a large sum, a huge chunk of amount we are going to pay out of cash, right? So the investors need to know it by today itself. They need to know that in 5 years' time, we will be giving a long-term benefit. Investors need to know. Investors need to know. Okay, investors need to know. And also, I really forgot to say all. Here, see, can you all remember? Here, see, let me mark that with a green color. Here, see, what this hand food course accountant has gone and done is he has gone and made a mistake. He has gone and made a mistake. Can you see here? What is the mistake? Can you see what's the mistake? Rather than going and showing it under P&L, he has gone and showed under other comprehensive income. Any remeasurement gain or loss, I told you all, if it's a long-term benefit, it has to go under P&L. He has gone and mentioned it under OCI. You see, therefore the accounting treatment is incorrect. Why? He should have showed it under profit or loss. He has gone and showed it under OCI. Right? This is what happens. That is wrong. Okay. So we are left off with last 3 points. We are left off with last 3 points. Okay. We are left off with last 3 points. What I would say, I would initially start with whether it's a long-term benefit or a short-term benefit or post-employment benefits. Okay. After it, I would tell about the accounting treatment, the similarity, the difference, and all. And after that, I would go and tell his accounting treatment is wrong. Why? I know the standard, I know its rules, right? According to the rules, this is wrong, right? So I go and tell, I give a conclusion that this is wrong. After that, I come up with the explanation of the calculation, right? I need to explain my calculation. Initially, we need to record a liability. Why? Because this is being paid in 5 years. Okay. And after that, obviously there are some, now this is liability related to statement of financial position, right? There is something related to P&L, right? You all need to pay net interest, right? You all need to pay net interest, which would be if you all have income minus interest cost, right? You all will have income minus interest cost, okay? As well as you all need to pay something known as the current service cost. You all need to pay something known as the current service cost. Also, in this particular requirement, here can you see, I told you all, right? Any remeasurement gain or loss, for long-term benefit goes under P&L. So here it is. Here it is. Right? Here it is. Okay. Do I need to speak about net interest? How do you all derive by net interest? Do I need to speak about it? Or shall I bring in a question that is related to net interest and do you all want me to explain? I would feel, what I personally feel, is that Okay. Yeah. So what I would personally feel is, guys, yeah, I totally understand that your already explained net interest, but the problem is, even though I explain it now to you all, okay, I need to show you all with calculations, right? I need to show you all with calculations so that you all understand this. This question does not have anything related to net interest, so I cannot show, right? So for now, let this be. For now, let this be, right? What you all need to know is just have it in your heads, right? Just have it in your heads for now. Any P&L components such as net interest, current service cost, and because of this, there is something long-term benefit and the remeasurement gains will be transferred to P&L. Okay. I will don't worry, I'll bring another question that is related to defined benefit scheme, and I'll show you all how do you all plot these in those past papers. Okay. So you all need to speak about profit or loss components. What would be respectively? What would they be? Current service cost is an expense. Net interest, which is net interest income minus interest cost, will give you a net interest, which is an expense. And also there's another gain or loss, right? There's another gain or loss, which could be either income or expense under your P&L. Okay. Now, here see, for each year, we need to calculate interest, right? That's what the DBP says. For each year, we need to calculate interest. That's what the DBP says. Defined benefit scheme says. Normally, the actuary gives us the opening balance as well, right? Based on that opening balance, always interest. Always remember, interest will be calculated on opening balance. Okay. Interest will always be calculated on opening balance. Make sure remember this. Make sure remember this. This is a golden keyword for all. This is a golden keyword for all. Interest, net interest or interest will be calculated on your opening balances of your defined benefit scheme. Right? Make sure remember this. Okay. This is one of your key points that I need to give you. Okay. So now we finally move on to our current service cost. How do you calculate current service cost? How do you calculate current service cost? I would do it with your. Let me do it with your. Let me do it with all. How do I calculate current service cost? How do I calculate current service cost? Okay, simple. First of all, my salary was 1.1 million. Okay, when was this? On 2002. Okay, but is this the salary that remains? Is this the salary that remains? No, right? Obviously, there is a 3% increase. There is a 3% increase in my salary from when? 1st January 2003. From 1st January 2003. Okay, to the power. When am I giving this particular salary? When am I releasing it? And now see here, I am releasing it from 1st January 2003 to, let me take your time, let me draw a graph. Let me draw a graph. Let me draw a simple graph. This would be, right? This would be 1st Jan 2002. Okay. After this would be 1st Jan 2003. Okay. This would be the date that you're giving, which would be 31st December 2006. What happened here? What happened here? What happened here? Your salary was 1.1 million. Okay. And at this point, your salary increased by 3% each year. Increase. Right? And this part is where you give. If you give benefit to employee. Right? This is where you give the benefit to the employee. Okay. So now what you all need to understand is you all need to show that the present value is for 4 years, not for 5 years. Why? Because in the middle there was a change in your salary. This is where most of you all go out, right? This is where most of you all, some of you all might fall for this trap, right? Because examiner purposely put this in. Examiner purposely put this in. Here, can you see here? Can you see here? He's giving the present value of year 4 and year 5. Why? There are some people who will start taking the present value for 5 years. would start taking the present value for 5 years, right? Which is totally wrong. Why? Because there was an increase in salary on 1st January 2003. So from 1st January 2003 to 31st December 2006 would give you all 4 years, right? Would give you all 4 years. So you all need to know that you all need to take the present value for 4 years, right? This is what I wanted to tell you. This is what I wanted to tell you. Okay. This is what I wanted to tell you. Can you see? Don't go and show the increase for 5 years. Why? The increase starts from 1st January 2003. Okay, the increase starts from 1st January 2003. Okay. So your increase in salary would be 1.2 million. 1.2 million. Okay. On that salary, or this salary would be your 31st December salary. 31st, 31st December salary. Right? On this salary, 1% would be your benefit. 1% is the employee benefit. Okay, 1% is your employee benefit. Okay, 1% would be your employee benefit. Out of that, now we come here. Out of that, does the entire 100% get? No, only 75 would get. Only 75 would get out of this. Right? Only 75% of the employees would get. Why? The remaining people left the employment. The remaining people left the employment. You see, benefit is only given for the people who stay till the agreed time. Obviously, right? Why would we give for the people who left our company? They are not needed. No point. No point keeping them in. Okay? No point keeping them in. Let me put this into whole numbers. Let me put this into whole numbers so that you all don't have. See here. I have put this into whole numbers. You all had initially 1.1 million salary. It grew up by 103% each year, right? At the final year, at the 5th year, your present value should be 1.238. Okay, would be your salary. That would be your salary in your year 5, right? That would be your salary in your year 5. But where we go wrong, where do our students go wrong? They would think, right? They would take the present value for 5 years, which is totally wrong. Why? There was an increase or there was a change, right? There was a change or upgrade in the salary. So you all need to take for 4 years the present value. Out of the final salary, which was 1.238 million, you all need to give 1% to your employees, which is 12 million, right? Do they get the entire amount? No. Why? Because only 75% people remain. Now comes the present value. Now comes the present value. Now comes the present value. Out of this, right? Out of this, what is the present value? The present value would be this is the amount that I'm going to pay. This is the final amount that I'm going to pay for the 75% employees, right? I need to find the present value. Here it is. They have given us the present value table also. Do I need to take 4 years present value or do I need to take the 5 years one? Do I need to take the 4 years one or do I need to take the 5 years one? Obviously, I told you all there is a change, right? Because of that change, we only start counting from 2003. So I need to take 0.823. I need to take 0.823. So this would be your answer. This would be your answer. This would be the present value of your current service cost. This would be your present value of your current service cost. Okay. This would be your service cost present value. Okay. Let me again repeat it. Let me again repeat it. Okay. Am I declaring salary on 1.1 million? No. Why? Because there was a 3% increase. Okay. There was a 3% increase. Okay. There was a 3% increase. That 3% increase, is it for 4 years or 5 years? It is for 4 years. Okay. It is for 4 years. Okay. This is a lump sum that I'm going to give you all. This is a lump sum. Okay. That is being releasing in your very 5th year. Okay. How much does the employee get? They only get 1% of that, your final salary. Okay. Do the entire 100% people get? No. Why? Only 75% employees remain in your company. Okay. Finally, you all need to find the present value. Obviously, right? You all cannot go and give it in a futuristic. You all cannot go and show your SOFP in a future value, right? You all need to show at today's terms. Okay, I need to show at today's terms. The today's terms value would be 7.641923. Okay, this is the one you all need to show. Okay, this is the one you all need to show. Here, see, there's an additional expense which is the service cost, right? How are they calculating it? How are they calculating? Now let me read. Let me read. Interest is recognized on annual basis, right? They calculate interest. They calculate interest. No problem. But since they have not given us the opening balance, they have not given us the opening balance for 2002. Examiner has not given us the opening balance for 2002. We cannot calculate interest. We cannot calculate interest for 2002. Okay, we cannot calculate interest. Let me read on. Handfood uses the project unit credit method. Never heard this method before. Okay, I guess it might be a made up method by the examiner. No problem. No problem. Let us read. Don't worry, this method is not there in your Kaplan text. Correct me if I'm wrong. I guess it's not there. I have never seen this. Right? Correct me if I'm wrong. It's not there. Just go ahead, check it. Okay. How does he want to do? Which means that the current service cost, right? Current service cost is the increase in the present value. Yes, obviously, of future benefit liabilities. Future benefit liabilities. What they're simply coming to say is, guys, to calculate current service cost, he is using a method called project unit credit method. Project unit credit method. Okay. And he's telling that this increase the present value. This increase the present value of future liabilities. This increases the present value of future liabilities. Let me show you all how. Let me show you all how. Here it is. Here it is. Obviously, right? When you all need to pay service cost, when you all need to pay service cost, right? Service cost is an expense, right? And this expense is related to your benefit, which is being paid in 5 years. This expense is related to your benefit, which is being paid in another 5 years, right? So that's why, can you see here the double entry? Debit service cost, credit benefit liability. Can you see here? Debit service cost, benefit credit liability. Okay. That is what I mentioned. This service cost is simple, guys. These are like obviously, right? You all need to hire staff to write those checks if you all are giving in checks, right? You all need to give some envelopes. There are multiple service related costs, right? You all need to there are so many costs related to long term benefits. Okay, administration cost, financing cost, multiple. That's why I have showed it as debit service cost and credit benefit liability. Credit benefit liability. Okay. Yes, see. And also we use this is not needed at all, right? This is not needed at all. This is just for your additional information, right? This is a prudence concept, right? This is something called as prudence concept. What does prudence concept say? If you all are going to show, if you all are going to pay in 5 years, 10 years, more than 2 years, right? Make sure that you all show it beforehand. Why? So that you all can have your shareholders satisfied. Shareholders satisfied in a manner where you all present true and fair view so that shareholders don't get panicked, so that shareholders don't get panicked in another 5 years saying that you all were, we were not informed, right? We did not know that you all have declared. Obviously, right? Shareholders don't know. So they will only look at our financial statements and they'll see. Okay, so we need to show under prudence concept, right? We need to show under prudence concept the present value. Okay. And this is also another additional this one. You all don't need it at all. This is how you all present it. You see, this is how you all present him. This is how you all present him in your 2002 balance sheet. In your 2002 balance sheet under non-current liability. Obviously, right? More than 5 years. More than 5 years, it's under non-current liability. Okay. I wanted to give you all some tips also. I wanted to give you all some tips as well. Right. Sorry, I could not prepare it properly because I just now left work and I prepared it in a hurry. Tip number one, right? IAS 1 does not let you all to reclassify. I mentioning this for the third time. There are some stuff that you all cannot reclassify. There are some stuff that you all cannot reclassify. One is a revaluation game. Always it remains in OCI. Always it remains in OCI. You all cannot never reclassify them back. You all can never reclassify them back. And finally, there is this IAS 19, right? IAS 19, the remeasurement gain I told for DBP. Let me put that in bracket. DBP, right? If there's any remeasurement gain in terms of defined benefit scheme, he goes to OCI. If there's any remeasurement gain related to long-term benefit, he goes to P&L. Okay, I'm speaking about defined benefit plan, right? That remeasurement gain will not be reclassified to P&L if it's a defined benefit pension scheme. Okay. And tip number two, I've showed you all difference between gratuity and pension, right? Gratuity is a one-time payment. A large chunk of amount will be given at once, right? Pension, you all go and ask my grandfathers, do they get it at once? No. Grandmothers, no, never, right? It will be credited to your accounts once in a quarter, monthly, like that. Okay, it's a continuous payment, a regular payment, right? Gratuity, why do they give you? Why do they give you? Because you're for your long-term service, right? You all are serving for more than 5 years, more than 2 years. Company values your efforts, so they will give you all, right? Why are they giving you all pension? Why are they giving you all pension? Because it's simply which is required by the law, right? That's it. That's it. That's it. Okay. And second question is also something similar to this, guys. Second question is also something similar to this, right? Which is 4 marks. 4 marks. What does he want me to do? Discuss the impact. Okay. Discuss the impact. On 31st December 2003, 31st December 2003, what is happening? They are going to change the assumptions, guys. They are going to change these assumptions. See here, there were three assumptions that was initially given by the examiner. These assumptions are going to change. Let us see. Okay, the same question, what they want to do is now they're changing the assumptions. They want to know by changing this particular assumption, what is going to happen. What is going to happen? Now see here. Now see here. Increase in employee salary above 3%. Above 3%. Can you see? Earlier it was 3% only. Now it is above 3%. Okay. They have not specified the exact amount. Anyways, above 3%. And a decrease in probability of employees leaving the company. So I guess now this can be, give me a minute. This can be say about 4%, 5%, any of it. Okay. And this can be 85%, 95%, any of it. Right. So what I want to say all, what I want to tell you all, by employees increasing, right? By employees increasing, obviously you all need to pay more money. Earlier you all were only paying. Simply logically think, simply logically think, simply logically think for these 4 marks. Simply logically, I want you to think. Earlier, you all needed to pay 75 employees only. Okay. But now employees are not leaving our company. Now employees are not leaving our company. So you all have about 85, 95 employees. Obviously, right? You all need to pay more cash, right? More cash, more cash for more employees, right? You all need to pay more cash for more employees. Okay. And also, earlier, you all were paying 3% bonus. Earlier, you all were paying 3%. Now, say a bonus increases, no problem. Bonus increases, no problem. But you all see that this 1% is related to your bonus. You now see here, these two people are related. 1% will be charged on your final salary, which includes the bonus, right? So there is a direct relationship. How how would I say there's a direct relationship? When my bonus increase, right? When my bonus increase, obviously the benefit also will increase. Obviously, right? Benefit increase. Refer calculations, right? If you all speak about this, guys, if you all speak about this, okay, you all might be able to get either 1 or 2 marks, right? Also, finally, yeah, another point that I want to tell you, another point that I want to tell you, another point that I want to tell you all can calculate interest income now. Now you can calculate interest income. How can I calculate interest income is, guys? You all obviously have an opening balance. This 2002 payable balance would be your 2003's opening balance, right? This 2002's present value of long-term benefit would be your 2003's opening balance. So you all can record, right? You all can record 2002 closing balance, right? You all can record interest. Okay. How much would be the interest? How much would be the interest? 7.64. 7.64 into 5%. Okay. This would be our interest. This would be our interest. This would be our interest, which would be 0.362. So, which would be 0.382. Okay. Which would be 0.382. This will be recorded in your 2003 P&L. Okay. This would be recorded in your 2003 as P&L in your interest expense. Okay. The double entry is also simple, guys. Obviously, all are now professional level people. Interest expense debit. Okay. You all need to predict the liability. Right. You all need to predict the liability. This is it. This is it. This is related to your third requirement. This is related to this requirement. Okay. This is it. This is it, guys. This is it. Obviously, people are increasing. We need to pay more money. We are giving 3%. We are giving more than 3%. So our bonuses are interconnected. Why? The more the salary, the more the 1% benefit increases. Okay. And also this time we can calculate the interest. Why? We have a opening balance from 2002, right? On that we can calculate interest expense. We can calculate interest expense. Okay. Which is, let me write that also. Let me show that as well. Here it is. Okay, this is how I came up. This is how I came up with my reserve. This is the double entry, interest account debit and credit liability. Correct? This is it, guys. This is it. This is it. This is more than enough. This is more than enough. Right? What I would want you all to do is, first of all, go and read IAS 19. Go and read IAS 19. Go and read IAS 19. Then after start off this question, you all be able to do it. If you all find any, and if you all have any learning gaps, any problems, right? Let me know. I'll try to help you out. Okay, I'll try to help you out. Now, this of course you all need to start writing, guys. I mean, you all are in skills. I mean, sorry, you all are in T levels. There's no one to spoon feed, right? You all need to write. You all need to develop. Then people are there to mentor, right? People are there to give their own advices. Okay, that's it. Anyways, have a very good night, right? Let us meet in our very next session of our recordings, right? See you all then. Thanks a lot.